Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing guest series on financial repression, I have Jeff Davis joining us this morning. Jeff is Managing Director of Mercer Capital's Financial Institutions Group. Welcome, Jeff.
Glad to be here.
Jeff, I thought we'd start with you giving a brief overview of your backgrounds. A lot of our listeners may not be familiar with yourself and Mercer Capital, if you could.
Yeah, so I'm a longtime observer of the commercial banking scene. I began my career at AmSouth Bank in Alabama, which is now one of the legacy companies that forms Regions Financial, one of the super regionals in the U.S., and have spent years as a sell-side analyst covering banks and specialty finance companies, including for firms such as Guggenheim, FTN Financial, and J.C. Bradford. But in any event, and then 3 years ago, in 2012, I joined Mercer Capital, and we are a valuation and financial advisory firm, and we work primarily with private equity as well as institutions, family wealth offices, and the like. And the overall theme of what we work on is valuation or related, maybe something related to capital structure, mostly for privately held institutions. So, but in any event, for me in my career, it has been about observing commercial banks and specialty finance companies. So topics like financial repression are certainly impact what we look at and how we think about it.
Jeff, one of the reasons that we wanted to talk to you was specifically about financial repression as it impacts the U.S. banks. Could you discuss with us what your views are on what financial repression is before we discuss the banks?
I'm going to lift from James Grant, who said it better, and that is it's a price control. And in terms of the Fed and central banks globally setting short-term rates at zero, or in the case of Europe and the Nordic countries below zero, it's simply a price control that, as it relates to all facets of the economy, both the financial and the Main Street economy, has profound impact. And it's something that's going to play out over the years, maybe even the decades. I think we've really just seen the beginning of the impact, if you will, from repression.
Our work suggests policies of financial repression will be with us for a protracted period of time. The macroprudential policies will take various forms as policies and regulatory actions are implemented to continue to support and ensure low interest rates and higher levels of inflation. But these actions will continue to push financial institutions further out on the risk curve. The point being, this isn't going to go away anytime soon.
Agreed, and we very much see that in the financial system, even within a generic commercial bank.
Let's talk about what this means to the U.S. banking system or banking sector now and in the future. You brought some slides on this that would be a good foundation to guide our discussion. Could you step us through them?
Yeah, sure. So from a commercial bank perspective, maybe even before going to the business model, is thinking about three cycles. There's the credit cycle, there is the business cycle, and then there is the rate cycle. And they're all overlaid. Gordon, it might, if we argue which comes first, well, it's sort of a chicken and egg thing. They all interact. And the banks, if you will, straddle all three in terms of being a key, not the only, but a key allocator of capital in the U.S. economy in terms of lending deposits back into the Main Street economy as well as to Wall Street. So in any event, financial repression impacts at a very base level the rate cycle, if you will, but there are implications for both the credit cycle and the business cycle, and that flows through into the banking system.
Jeff, my experience has been that most investors don't think of cycles in this manner, specifically equity investors. I know for a fact credit and bond investors do.
Yeah, oh, I would agree, and I would maybe because I covered banks, and for instance at Mercer, probably 20% of my time is spent looking at debt securities, not just equity securities, is particularly for public equity investors. The focus is really on what is a given company going to make next quarter, next year, maybe 2 years out, and it's really that dynamic of growth which speaks a little bit more to maybe what's going on in the Main Street economy and that dynamic in terms of what is going to drive a company's earnings or cash flow above what expectations are or below that, when the bond market may very well be signaling that the economy is on the cusp of slowing down dramatically, as was the case in 2006, in late 2006 and into 2007, when the 10-year yield was sitting pretty much on top of the 2-year yield, and that was a sign that the Fed was behind the curve and the economy was getting ready to slow. In the equity markets, it took really the Bear Stearns event in the summer of '07 when their hedge funds failed, which, by the way, were credit-related or credit-focused funds, for the equity markets to really start to focus on what the corporate bond market had started to take notice on, I would say 9 months earlier, going back into late '06.
You have a chart on commercial banks that differentiates between lending to Main Street and Wall Street and the difference between deposit flows and payment systems.
Yeah, so this is a chart that I do a class each year. SNL has a bank analyst training program, and this is one of my basic charts. It may seem straightforward, but I put it out there because I think when maybe individuals think about banks, there's not a full understanding of how they function, what the business model is. And you say banks are generically thrown in the lexicon. In the media, there is an association with Wall Street, and that's certainly an aspect, but at core function, if you and I formed a bank, and let's say we put in $100 of capital, that's on the right-hand side of the balance sheet, and we have $100 of cash on the left-hand side, our objective in time is to leverage that, and we take in deposits. We have a fractional deposit system in this country, as we have globally. And I think historically that goes back to the Dutch, maybe in the 1600s, when that was really more formalized. But in any event, the deposits are lent out, and we build a balance sheet that in time should consist of cash, some bonds, and then primarily loans, and those would be our earning assets. And then they're funded with deposits, maybe a little bit of debt, and then our original equity capital. So the objective for a bank is to earn a spread on the assets, the loans being the highest yielding assets with a little bit more risk, the bonds less so, and then the cash even less risk, and certainly these days is a non-earning asset. So the bank's role in the economy is to take the deposits and prudently, but still take risk and lend the money into the economy, into the Main Street economy, and that helps finance the economy. So the banks are really, in a sense, Gordon, they really are special to be segregated from commerce, and they straddle this as a capital allocator in the economy. And then the overlay is the credit cycle and what's going on in the Main Street economy, and then the rate cycle.
Now, you have on this chart the shadow banking system up here in the top right-hand corner. How does the shadow banking system play in?
Let me loosely say that banks have approximately 30% of the credit outstanding, or about 30% of the credit in the U.S. system sits on a bank balance sheet. And maybe if we went back to the time of the Depression, my guess is that number was probably 65, 70%. But during the last several decades, the shadow banking system has developed as an alternative lender, as well as an alternative place for you and me and others to place money. So a very simple example would be a money market fund. A money market fund could be considered part of the shadow banking system, where we may place funds outside of the banking system, and then the money market makes fairly safe or very safe short-term loans, for instance, in the corporate commercial paper market. But in any event, the shadow banking system is separate from the commercial banking system, but is a very large piece of the credit allocator today, and to some extent is dependent on banks for some funding, although shadow banks look to the wholesale markets for much of the funding. So maybe stepping back from and thinking about the changes since the financial crisis, I don't think there was a great appreciation among regulators, investors, that how big the shadow banking system had become. And so we really saw more issues in the shadow banking system first, and then they spilled over into the traditional banking system. So some of the regulatory changes we've had since the financial crisis have been geared to make the banks much more able to withstand a shock, primarily through holding more capital, probably not a bad thing. But at the same time, a lot of the risk has been pushed out of the commercial banking system, and it resides now in the shadow banking system, where it's more opaque, not as transparent as perhaps looking at a commercial bank.
The explosion in securitization with the growth in asset-backed securities to finance auto loans, mortgage-backed securities to finance housing, Sallie Mae's credit, collateralized loan obligations to finance student loans, etc., are all about the creation of credit. But this debt growth still isn't even enough. And now we hear renewed talk of helicopter money, or OMF, overt monetary finance. What does that terminology mean to you, and is it a realistic possibility?
Well, so for helicopter money, in a sense, we've seen it since the financial crisis with quantitative easing. But when I think of helicopter money now, I think about a few of we're starting to see in the financial media, not maybe the Main Street media, in terms of during the next downturn or crisis, be it central banks or the governments that are financed directly by central banks now, of placing money directly into citizens' bank accounts. And it's maybe too clever, if you will, but there's a simplicity in that if one believes in that type of monetary policy, and that it bypasses Wall Street and institutions such as, not that they're institutions per se, but segments of the financial economy such as the shadow banking system, in terms of trying to inject money directly into Main Street economy, where the hope is it'll be spent and create a multiplier effect. My guess is that it's too clever. It won't work. It's part of this something for nothing scheme, that much of what maybe that would be another way to describe financial repression as something for nothing. But in any event, that's what I think about helicopter money is I get a check from the IRS directly. And Gordon, before I forget, in terms of thinking about financial repression and the banks, I remember in early 2009, I was calling on a portfolio manager at Goldman Sachs, and this person worked small caps, and my beat was primarily small caps and mid cap financials, which has always been my passion, as opposed to being the 33rd analyst on Bank of America, which I've covered in the past. But this person had told me that she had just met with their Japanese team, and part of their dialogue was, what do zero rates mean for the banks? And the Japanese team that responded to this U.S. person was, it's a 2 handle on net interest margins. And the point was, going back 20 years, and I know the Bank of Japan raised rates when? In 2000, maybe 98. They tried to get off the dime a couple of times, and obviously that didn't work. But in any event, over a couple decades, the net interest margin at the Japanese banks had been significantly eroded. And so it just got me to thinking in terms of our banks. My view was, at the time, as it is today, they're stuck. Whether they raise rates 1 or 2 times, the system's stuck. And as a result, the spread, we'll see in the U.S. banks what's happened in the Japanese banks, and that is the net interest margins over time will compress dramatically. It doesn't necessarily mean quarter to quarter, and each balance sheet can have different nuances, but over time, it's going to be a much lower net interest margin.
I apologize. I think I took us away from the slides that you brought with you.
Yeah. So it has mattered in a couple places. So financial repression, if you think about zero rates today, it's very painful for an institution to hold cash. So there is, I think, significant risk-taking occurring among commercial banks in terms of taking additional credit risk as well as additional duration risk. And that could be in a commercial real estate loan or it could be in the bond portfolio. But structurally, banks earn a spread on their assets relative to the deposits and borrowings that fund those assets. If you think about a traditional commercial bank where maybe 20 to 30% of the deposits are not interest-bearing deposits, when short-term rates are 4 or 5%, the spread is really good, particularly on the non-interest-bearing deposit side. When rates are as low as they are today, the non-interest-bearing deposit franchise is really devalued. And for a business model like a shadow bank system that may borrow money in the repo market at 30 days, 90 days, 180 days, that scenario works in terms of their funding zero. But so for the commercial bank, having cash sit around that is funded with deposit that yields nothing, the deposits, the cost of funds are close to zero, there's a real incentive to push the money out into assets with yield, just like we see with individuals who may have used to have been investors in money markets, short-term bond funds, and CDs. They've been pushed out the risk curve. The same thing is occurring with commercial banks. And so there's more risk-taking in terms of the credit and duration. I've got a number of bankers have commented to me that memories are short. They're seeing the behaviors they were seeing in 05, 06, maybe for different reasons this time. And also should note that maybe the rate regime is not any different than it was in 2012, but as we've gotten further into this, what I think is a recovery, it's hardly robust, but it has been a recovery, is the willingness now that we're 3-4 years in to take much more risk is it's rising across the system. So, but in any event, the banks, so that's one place the banks were impacted. Secondly, as it relates to credit, the financial repression has artificially pumped up asset values. Commercial real estate's a good example. I've got a slide in there which shows commercial real estate values going back to 2000. They really pivoted back when 4 or 5 years ago in about 2010. And with the reduction in rates, when we think about commercial real estate, it's the long-term rates, present value of cash flows go up. Well, banks lend against that. And so there's additional risk in the system now that asset values are pumped up, and what may be a prudent loan with, let's say, a 60 or 70% loan to value, if the assets doubled in value over the last 4 or 5 years, the margin of safety is just not there. So that's another place where financial repression impacts banks as well as the financial system generally. And then there are other places, the bond portfolios. If rates were really to move up, there would be huge losses in the bond portfolios. Now, I'm in the camp that given the soup we're in, that any spike up in, let's say, the 10-year here in the U.S. is likely to be temporary. But in any event, that's another place there has been risk. And then lastly, on financial repression and how it impacts the banks is this reach for yield, cash is trash. It also means the marginal credit is a credit that a lender can take a chance on. So there are a number of zombie companies that would have failed in, pick your year, 2009 or 2010, that were given a new lifeline. And companies don't go broke because they don't make money. And the same would be true for a nonprofit or a government entity. Entities go broke when they have no liquidity. So what zero rates has done is push liquidity into the system. Presently, we're seeing it in the shale oil structure in terms of companies with inadequately capitalized companies, heavily indebted, were able to borrow money, and now we're seeing the piper to be paid with that, which will be losses taken in 2016 and 2017 as that sector sorts itself out. That has gone on all over the economy. But until we have the next downturn, the loans will be rolled and we won't see the losses. Credit is always, but also borrowing from Jim Grant, is credit is forever cyclical. And we're on the swing where credit metrics are good. And I will tell you this, we work with banks all over the country, and what we're seeing, though, is among community banks is loan demand is, in some markets it's spotty, in other markets it's pretty good, but because of the repression on rates, is banks are looking for reasons to push money out, and that will include for small businesses that would not have been the case 2 years ago. Now, they may end up being bad credit decisions, but we won't know until the next downturn. You've got a couple other slides that I just wanted to, as we think about banks, there are maybe three levers to think about. One is the return on assets, and this is looking at the long-term slide. And you can see from the 90s into the 2000s, we just did not have a cyclical downturn. If Alan Greenspan were commenting on it, he might call that the great moderation. And since the crisis, earnings have rebounded, but at a lower level. So what used to maybe a good return on assets pre-crisis, let's say 1.2%, 1.3% if you're a really high performer. Today it's about 1%. And I've got a slide in there which shows various size banks pre-crisis, post-crisis, and you can see where the return on assets are lower and the return on equity is lower, the margin's down, and then if we'll look at the slide that shows capital ratios, so capital as a percent of assets, and the core capital ratio we look at in the banking system is the leverage ratio. You can see, interestingly, over the last 20 years or so, the industry has been building capital. I don't think that's a bad thing. We are significantly much better capitalized than Europe, which is a good thing in this country. But as it relates to an investor, there's a lower return on equity, and you can look at the slide. If we look at the slide which shows the long-term return on equity over the years, it's much lower than it was pre-crisis. And that's a function of financial repression, and then secondly, a function of regulations that are requiring banks to hold more capital.
Switching gears slightly, we have excess reserves at the Federal Reserve, well in excess of $2 trillion. It doesn't seem to be falling. Comments on what is going on that is driving it and what we can expect?
Yeah, well, that's if we had so back to our three circles from our first or second slide, and if Main Street was in need of more loans, if this economy was hotter, we would see the banks draw those reserves down. So I don't have a slide of the Federal Reserve balance sheet, but the reserves, you can think of the reserves as the Fed's deposit that a bank might make. Chase or Bank of America is their excess cash that they don't have reason to lend out. They don't want to put it into the bond market. They've got all the bonds they want. It's sitting at the Fed where the Fed's paying them 25 basis points. And so the Fed has bought bonds from the banks to create the reserves. So if the economy were to heat up, we'll see the banks draw the cash down and lend it into the economy, and then the Fed presumably would sell bonds to create the cash to transfer over to the banks. But in effect, it's just simply sitting there. So we've gone through this quantitative easing, the various permutations of it. The Fed has built up its balance sheet, and at least from a government statistical perspective, we haven't seen inflation. I know there's inflation everywhere, but to the extent, let's go with the government stats, why haven't we seen a ton of inflation? Well, these reserves are sitting there, and if the economy were hot, they'd be drawn down, and then this money, just this really freewheeling money flowing through the Main Street economy would flow, I think, very quickly. In 2010, Dennis Lockhart, I believe it was 2010, it could have been 2011, and I can track down the note and send it to you if you want. He spoke to the Nashville CFA Society, and he was very emphatic. I guess the Fed had probably just started QE2 at the time, or maybe it was Operation Twist, and he was very emphatic and said, the Fed will never, ever monetize the debt. Well, that's what quantitative easing has been. The Fed has, in effect, created money, the reserves, if you will, to buy the bonds from the primary dealers. That action is recorded, if you will, on the Fed balance sheet. It sits there today. I think they'll never be able to unwind it unless the federal government figures out a way to run a structural surplus, and then they could unwind it, if you will. But the Fed has been drafted to support the economy, maybe in a perverse way that you and I might think, but they've been drafted, and I suspect they're going to be drafted in a few years to fund the massive growth and entitlement spendings we'll see in this country.
Jeff, we're running out of time. What are your primary concerns with sustained low interest rates and a long-term continuing policy or policies of financial repression?
Well, the loss recognition is delayed, so it's an artificial world, and maybe it always has been. I guess after World War II, until we had the Treasury Accord, where the Fed became somewhat independent again in '52, and we had financial repression through the 30s and through World War II out of necessity, and then really through the Korean War. But it's a delay of loss recognition. There is to the extent we talk about malinvestment, TAO, commercial real estate, being a bigger piece of the economy than maybe it should. That is all a credit risk within the banking system. So one day there'll be a reckoning whether the air can be let out of the balloon slowly. Don't know. It didn't happen last time, but it's simply a buildup of risk and an attempt by the central authorities, if you will, to guide the economy, and the banks straddle it, and the balance sheets reflect risks that aren't always apparent in any given quarter or any given year's financial statements.
Jeff, what keeps you up at nights?
Oh, I tend to sleep well. I would be more concerned about a dramatic slowdown in the economy. Short rates are at zero. If the economy really heated up and maybe we saw government inflation pick up, that's probably a scenario that'll be easier to manage. Banks probably will be okay with that. There'll be some with some large unrealized losses in their bond portfolios, but they can work with that. It's more of the European scenario. The economy slows down. The Fed takes short rates negative. Let's say the 10-year goes to 1%. And in terms of thinking about being an investor in a bank, you come back to the question, how do you earn a spread on that? Well, you don't. And some banks will have fee businesses that create an offset. You've got a nice one in Boston Financial Private. But most are traditional spread lenders, and we've seen consolidation in the industry forced in part because of this interest rate regime we have. In that type scenario, it will have to accelerate. It will. The community banks that service small town America around this country will be in dire straits, maybe a tad too strong, but they are emerging right now because of the regulatory hassles they're having to deal with, and these declining margins becomes all the more pronounced in that type scenario.
I'm looking at all of the regional Fed's reports in the last 30 days, and they're all showing significant slowdown. And, we're all well aware of the degree of slowdown we're seeing globally. So I share your concerns that I think that is not a very strong possibility, actually.
Yeah, so would agree. So one thing, thinking about banks and these cycles is, so the bond market has been giving us a heads up that the economy is slowing, the yield curve, and I've got a slide at the end which will show how low rates are, but the yield curve is still steep relative to history, but it's not as steep as it was a year ago if we look at the spread between the 10-year and the 2-year. And that when that flattens, that has historically been a sign that the economy is slowing. Doesn't necessarily mean recession, but it has very much been giving the traditional indication of a slowing economy. What's interesting, though, Gordon, in terms of thinking about banks, and I talked about lending and broadening out, is the lending to Main Street is late cycle. So that's not necessarily, the two aren't necessarily contradictory, is that Main Street economy is sort of the last to turn up and the last to go down, if you will. The capital markets are the first to sense trouble and usually the first to turn around. We saw that in 2009, where the capital markets pivoted in 2009. Bank financials and losses didn't peak until 2010.
Yeah, exactly right. I look at the S&P, I see that we've had 2 consecutive quarters of down revenues on the top line, negative growth. That means we're in a revenue recession. We have it in earnings, except that it's hidden with earnings per share because of the massive amount of buybacks that have been going on that are inflating the numbers. But it's the evidence is there for anybody who cares to look at it. And it's always the equity markets, by the way, that is the tail on the end of the dog. The last two.
Agreed. And liquidity is a powerful thing, including in
Jeff,
the capital
any
markets.
Last messages you'd like to leave with our investors?
Well, no, I think in terms of investors and thinking about banks, just structurally, they're not going to make as much money as they used to. It just is what it is, and it's probably better to think about earnings multiples on normalized earnings rather than book multiples because the return on equities are lower. If you're an investor in up the capital structure in preferred or debt, the margin of safety is much better than, say, pre-crisis because the banks run with a lot more common equity than they did pre-crisis. And would completely agree with you that within parts of the bond market, the CLO market, for instance, CLO equity subtranches have gone bidless this summer, very similar to subprime CDOs, the lower tranches of those types of CDOs pre-crisis, where they started to go bidless in the summer of 2007.
Jeff, there are remarkable correlations to be seen right now that are actually truly frightening. Could you tell our listeners how they could learn more about your writings and Mercer, and also your recent article on contrasting the bond market with the equity markets, to specifically Bill Gross and Warren Buffett, in terms of ability to achieve returns?
Yeah, well, and feel free to post that if you want as part of this. So I write a column for SNL Financial. Now, it is behind a paywall, but it's called Nashville Notes. So your viewers who are deep into the financials should have access to SNL. I do post on Twitter about every 2 weeks. I'll post my writings there under Jeff K. Davis 1, and certainly one can go to Mercer Capital. We have a lot of content, but you can find it on the website. It's mercercapital.com, and then just do a search for Nashville Notes, and it'll turn up. Also, be happy to link in with folks via LinkedIn. So Jeff Davis at Mercer Capital.
Jeff, thanks for your time. Great discussion. We'll have to have you back again.
All right. Thank you very much. Take care.